Okay, so just imagine this for a second. You finally bought your dream car. You're so excited. But then the absolute worst happens. It gets stolen or it's totaled in an accident. You think, phew, thank goodness I have insurance, right? But what if the payout you get is, well, a pretty painful shock? Let's dive into how you can make sure you get the full value your car is actually worth.
So let's kick things off with a real story. A brand new car worth a cool 20 lakh rupees just vanishes, gone. The owner does what you're supposed to do, files an insurance claim, and just expects to get that money back so they can get a new car.
But here's where it gets crazy. The check from the insurance company finally shows up and it's for only 14 lakh rupees. That's a massive 6 lakh rupees shortfall. So where on earth did the rest of the money go? That is the big question we're going to answer right now. And look, this isn't just some made-up example. This is the real story of a car owner named Ayush. And he was just left staring at this number, wondering how his comprehensive insurance policy could leave him with such a huge financial hole to fill.
I mean, a 6 lakh rupee gap, that is a really tough pill to swallow. That's the difference between being able to actually replace your stolen car and, well, having to scramble to find a huge amount of money from your own pocket. So what is the deal here?
Well, the culprit has a name, and it's called depreciation. You know, in the world of standard car insurance, it's kind of the silent villain that can dramatically slash your payout. Let's break down exactly how it works. See, your standard policy pays out something called the IDV, or Insured Declared Value. Now, this isn't what you paid for the car, it's what the car is worth today. And as we all know, a car starts losing value literally the second you drive it off the lot.
And we're not talking about a small drop either. A car can lose up to 30% of its value in just the first 2 or 3 years. That is a huge chunk of your initial investment, just poof, gone, all thanks to depreciation.
And this quote just hits the nail on the head. Your policy is designed from the ground up to pay the depreciated value, not the price you paid. The system is actually working as intended, but that intention can end up costing you a ton of money. The good news, though, there is a fix. Yup, there is. And it's a simple but incredibly powerful insurance add-on called Return to Invoice, or RTI. This little thing is the key to closing that painful depreciation gap. Let's see how it becomes the hero of this story.
The solution is actually pretty straightforward. An RTI add-on completely flips the insurance calculation on its head. Instead of paying you the car's current lower market value, it promises to pay you back the original price right from your invoice.
And when we say invoice value, we mean pretty much the whole shebang. It covers the ex-showroom price of the vehicle, plus those registration costs and the road tax you paid. In other words, you get the full amount back.
Okay, this little chart here is the real aha moment. On one side, you've got the standard policy, which gets you the IDV. That's the value that just keeps shrinking every single year. On the other side, the RTI add-on gets you the invoice value, the full price you paid. The difference is just crystal clear.
So when does this awesome add-on actually kick in? Well, it applies in 2 very specific, very serious situations. First, if your car is stolen and the police declare it unrecoverable. And second, if your car is damaged so badly that it's declared a total loss, which basically means it would cost more to fix it than what it's currently worth.
So, this RTI add-on sounds pretty great, right? But is it for everyone? Let's quickly run through a little checklist to help you figure out if RTI is a smart move for your situation. You should definitely think about getting RTI in a few key scenarios. First, if your car is brand new, since depreciation hits the hardest in those first few years. It's also a real game changer for premium or luxury cars, where that value gap would be massive. And finally, if you live in a high-risk area or you still have a loan on the car, this add-on gives you some seriously critical protection. Now listen up, because here's a really important catch. This is not something you can just add on whenever you feel like it. RTI is typically only offered for new cars, usually up to 3 years old. And you often have to add it right when you buy the car or very soon after. So timing is absolutely everything. All right, so it all comes down to the final calculation, doesn't it? Is the extra cost really worth the incredible peace of mind that this thing offers? Let's take a quick look at the numbers. Generally speaking, adding RTI to your policy is going to cost you about 10% more than your standard comprehensive premium. Now, that amount can vary a bit depending on your car, but 10% is a pretty good ballpark figure to keep in mind.
And when you really think about it, that relatively small extra cost, it's like a firewall. It's what protects you from a potentially massive financial loss. It's the difference between being covered and, well, facing a 6 lakh rupee shortfall. All of a sudden, that 10% premium seems like a pretty tiny price to pay to avoid the kind of devastating financial hit that Ayush had to deal with. And that's the question we'll leave you with. It's really the core of the whole decision. When you weigh the small, predictable cost of an add-on against the huge, unpredictable risk of a total loss, well, the choice becomes a lot clearer, doesn't it? This isn't just about insurance. It's a strategy to protect your investment. So, what would you choose?